What if I told you that most people run out of their retirement savings 10 to 15 years too early, without even realizing it's happening? And the scariest part? It's all because they never learned the simple rules for safe withdrawals. Are you sure you won't make the same mistake? Stick around, because the information in this video could be the difference between a comfortable retirement and a financial nightmare. Welcome to our channel, your guide to financial independence. This is the 19th episode in our 30-part series, and today we're tackling a question that will define your future. How much can you safely withdraw from your retirement savings each year? Let's start with the most famous rule out there, the 4% rule. Have you heard of it? It sounds simple, and it's been a go-to for financial planners for decades. Here's how it works. In your first year of retirement, you withdraw 4% of your total portfolio. After that, you adjust that dollar amount for inflation each year. The theory is, if you follow this rule, your money has a very high chance of lasting for at least 30 years. For example, if you retire with a portfolio of $500,000, the 4% rule says you can take out $20,000 in your first year. The next year, if inflation is, say, 3%, you would withdraw $20,600. It gives you a predictable income stream, which sounds great, right? But what if I told you this rule, created in the 1990s, might be dangerously outdated for today's world? The truth is, the 4% rule is not foolproof. There are some serious limitations you need to know about. Think about it. What happens if the stock market crashes right after you retire? This is what experts call sequence of returns risk. If your portfolio takes a big hit early on, and you keep withdrawing that same inflation-adjusted amount, you're selling your investments when they're down. This can drain your savings much faster than you planned. And here's another thing. What if you live longer than 30 years in retirement? With modern medicine, living to 95 or even 100 is becoming more common. Will your money last that long with the 4% rule? Maybe not. Then there's inflation. The original study was based on historical US data, but what happens when we see periods of high, stubborn inflation like we have recently? Your purchasing power gets eaten away, and the 4% might not be enough to live on, forcing you to withdraw more. Finally, life happens. What if you need a new roof or have a major medical expense? A big, unexpected withdrawal can throw the whole plan off track. Relying solely on the 4% rule is like navigating a modern highway with a map from 30 years ago. It might get you there, but the risks are much higher today. So if the 4% rule has cracks, what are the alternatives? Are there safer, more flexible ways to make your money last? Absolutely. Let's explore a few powerful strategies that can give you more security. First up is the 3% rule. It is exactly what it sounds like. You withdraw 3% of your portfolio in the first year instead of 4%. Yes, this means a smaller initial income. But for many people, especially those planning a long retirement of 40 or 50 years, this ultra-conservative approach drastically increases the odds that your money will outlive you. It builds a much bigger safety cushion for market downturns and unexpected costs. If you're a bit nervous about outliving your savings, this might be the peace of mind you're looking for. Next, let's talk about flexible withdrawals. This is a more dynamic approach that adapts to reality. The idea is simple. In years when the market does really well, you can withdraw a little more. Maybe 5%, but in years when the market is down, you tighten your belt and withdraw less, say 3%. This is just common sense, right? You wouldn't speed up in a blizzard. This method helps you avoid selling your assets at low prices and allows your portfolio to recover and grow during the good years. It requires more discipline, but it can significantly extend the life of your savings. Another popular strategy is the bucket strategy. Imagine you have 3 buckets for your money. Bucket 1 is for your short-term needs, covering 1 to 3 years of living expenses. You keep this in ultra-safe assets like cash or a high-yield savings account. It's your sleep-at-night money. Bucket 2 is for your mid-term goals, maybe 3 to 10 years out. This can be invested in lower-risk bonds. And bucket 3 is for long-term growth, 10 years and beyond. This is where you keep your stocks, where they have time to grow and recover from any market dips. As you spend from your cash bucket, you refill it by selling assets from your bond bucket, and you refill the bond bucket by selling from your stock bucket when the market is doing well. This system protects you from having to sell stocks in a panic during a market crash. Finally, there's the dividend income strategy. Instead of focusing on selling shares, you build a portfolio of high-quality stocks that pay reliable dividends. The goal is to live off the income these dividends generate without ever touching the principal. This can be a fantastic way to create a perpetual income stream if your dividend income covers your expenses. You're not forced to sell shares. Regardless of what the market is doing, your portfolio can continue to grow over time, and your income can even increase as companies raise their dividends. Let's make this real with a quick example. Imagine you retire with a $1 million portfolio. Using the standard 4% rule, you'd get an income of $40,000 per year. Not bad. But if you're worried about the future and opt for the more conservative 3% rule, your income would be $30,000 a year. That's a big difference, but it buys you a lot more security. Now, what if you used a flexible strategy? In a good year, you might take out $50,000 for that dream trip. In a bad year, you might cut back to $30,000. Over the long run, studies show that these flexible approaches can make a portfolio last much longer than a rigid 4% withdrawal. The key isn't just how much you have, it's how you use it. Which of these strategies feels right for you? A smart withdrawal plan is the ultimate defense for your retirement. It protects your income for decades and prevents you from running out of money when you need it most. It's not about being fearful, it's about being prepared. The decisions you make about this will define the quality of your life for the next 20, 30, or even 40 years. If you found this helpful and want more practical retirement strategies that actually work, make sure you subscribe to our channel and hit that notification bell. Your future self depends on the knowledge you gain today. Thanks for watching, and we'll see you in the next video.